Hello, everybody. Today I have a very special video for you. It's an interview that I've done with a guy named EconDegen. He's like a big brain options trader guy type person who works with ETH strategy. Now, ETH strategy has a few cool products. If you open up their DApp here, you can see they have this ESPN, which is basically it's you can deposit some stable coins in here, and you're basically lending stable coins to the protocol, and they put them to work with like covered calls, bonding, and all this kind of crazy stuff, right? I've got a video on ESPN that you can watch to understand it more deeper. And then there's also this product called Strat, which the only way to get Strat now is to buy it from the market. I am biased on Strat itself because I did pre-mint this. I was part of the seed raise people, so I have Strat actually deposited in here, staked in here, earning this 9% APR in ETH. So I'm actually earning ETH every couple like little. I don't know. I don't claim it every day because it's only 9%, and I didn't put hundreds of thousands of dollars in here. So I claim it when it makes sense to claim it, right? But today we spent a lot of time talking about this thing that they're going to put out in March. These bonds where you can basically do the same thing that they're doing here in ESPN, that they're doing under the hood, but you can do it manually, and it has all these different kinds of options. So I'm not going to explain to you everything because he's going to do it for you. This is a pretty long episode. It's over an hour long of him and me talking about these options and how these things work. So buckle up, and if have some patience, grab us some coffee or some snacks, and listen to this guy teach me about this stuff. It's pretty cool. All right. So EconDegen. So we're going to talk about bonds today and pretty much the whole suite of ETH strategy. So bonds are pretty hard for me. That I don't completely understand this. I've read all these articles that you guys put out and stuff like that, and I do find it a little bit intimidating. But I do like to learn, so I've reached out to you, and I'm hoping you can enlighten me on some of the things here. So you've given me some stuff to share and to kind of walk through, and I'll listen to you for the most part. And if I have any questions, I will ask. So take it away, Econ.
Yeah, GM. So super excited to be here. Thanks for having me sort of on here, Ceazor, and super keen to talk about bonds and what we're bringing to the market. I personally think that this is one of the coolest products that that's going to come out in DeFi this year. I'm partial, of course, but I hope that if you're watching this video and you personally, Ceazor, at the end of this sort of, I guess, introduction to bonds, I hope that you see why I think this is so cool. I think we're doing some really, really novel stuff, and you can use these bonds in many, many different ways. I think from a question standpoint, at any time when there's something that you want to dig into, let's jump into that. And I know that I can talk a lot about this stuff. I can talk sort of basically forever about this stuff. So you should definitely sort of step in when you feel like that there's an interesting question.
Yeah, if I get lost either, I'll pause you. Don't worry, I'm good at asking teachers questions. I always have been, so I will bug you if it.
There's no such thing as stupid questions, right? That's what they say. And I think this is the thing. Like I honestly believe that this is really, really cool. We built some really, really cool things, and I want to dig in. I want to dig into sort of like why I think this is so awesome, why I think this is so cool. I think there's nothing hidden, nothing sort of off the table, sort of in this. I don't know whether you call this an interview or in this sort of like.
We'll call it a professor session.
Professor session, right? There's nothing off the table here, because I think so much of DeFi is, is a little bit hidden, a little bit opaque. I think here we've got something genuinely cool. We want people to have it, to take it and play with it. I think sort of starting sort of like generally as well. I think I think what we're bringing to the space that hasn't really existed before is we're bringing sort of options, and you might say sort of like cheap options to the space. And I think a lot of people sort of think of us as sort of an options platform, and I wouldn't say that's actually accurate. I don't think of us as an options platform. I think of us more of a options provider. So we're not competitive to people like Derive. We actually work with the Derive guys, and I love the Derive guys, and I think they're building something really, really cool. I'd say they're an options platform and a very good options platform on that at that. And we're more of an options provider to the market. So you
Can
might say
I let me jump in here for a sec? Like, Derive has options. There's been options around since I've joined DeFi, and
yes.
before DeFi, I had no idea what options were. And then I started digging in, and I found, there's Hedgic and Derive and all these different options platforms through but what I don't really understand, just as a general, like why do people even want to trade options? Like, to me, it's kind of like, if you want to go long, you just buy the token, or you leverage long it or something. Why would you use an option?
I think that's a great question. Options are fundamentally valuable instruments, and they're fundamentally valuable in a fairly hidden dimension. So if you look at sort of options sort of intrinsically, there are two sources of value for the options. So there's what you call intrinsic value, which is if we exercise it today, we'll get X amount of dollars. And there's what we call time value of options. And time value is something that exists only for options. It doesn't exist for like spot markets, for example. And so if you're able to sort of manipulate this time value of the options, you're able to sort of make extra money, right? And as we'll go through today, the reason why we're able to sort of generate yield out of the options that ETH strategy provides, and we'll show various strategies on how to do that, is because we're basically using this time value of money to generate this yield, right? We're basically banking on theta decay, essentially, is what they call it, right? Which is time value decay, in order to generate this yield. And so I guess sort of there's a roundabout way of sort of talking about things, but to sort of specifically answer your question, why options? I think options are valuable. Options give a flexibility that other asset classes don't. It's a very, very interesting derivative. And we'll get into sort of why exactly it's so cool and so interesting. And I think sort of most importantly for ETH strategy, like every other asset, if you can get it for cheap, and for ETH strategy, you can get it for cheap, and I'll explain exactly why you're getting it for cheap later. If you can get it for cheap, you can make supersized returns on it. And I think that's the most important thing, right? So options inherently, and I think probably, we've all kind of experienced this, right? Derive's great and it's efficient, but if you play options on Derive, on average, you're losing money because, if you try to use it as a leverage tool, when you're buying options, because you're taking sort of a positive view on volatility, the other side, who is short volatility, needs to make some sort of average return. And so you end up paying for that positive exposure for volatility. With ETH strategy options, you can use, and when I say we're an options provider, I mean that, right? So the way that you actually monetize the value you get out of ETH strategy options is in many cases up to you, right? For ESPN, which is our internal vault, we've used Derive, but obviously can use other platforms as well. There's some other really, really cool platforms out there that you can use to sort of try and monetize your options. So for our ETH strategy options, you're getting them for cheap. So you're actually able to sort of create a consistent long-term yield out of them. So I think that's sort of the fundamental shift. Yeah. I think sort of up to this point, especially for retail, you've been limited from an options perspective to using it for leverage, for example, and maybe a little bit of hedging. But it hasn't been a consistent way to sort of generate sort of long-term yield. I think because of the way ETH strategy is set up, we essentially have a mandate to give people cheaper options And because of that fact, you're able to sort of generate yield that you're not able to on just an options platform.
Would you say that, like most traditionally, options have been used primarily to hedge risk or to leverage bet on positions?
So I would say it depends on who we're talking about, yeah? So if we
Mm,
look at the TradFi market as a whole, the question is, why is the demand for options sort of overall? Sort of the end user for most options are sort of risk hedges.
mm,
So I would say like the sort of the fundamental demand for options is someone who's trying to hedge risk in one way or another. Uh, I'd say if you want to go leverage long on something, uh, I think options are a reasonable way to go leverage long. Um, but I don't think that I think it's a different way, right? So I don't think it's sort of like necessarily superior to going leverage long on a perp or going leverage long on sort of a traditional borrow lend like an Aave, for
yeah,
example,
like a loop or something.
like a loop. So I think they have different pros and cons, right? So the pro of an option, of course, is that you cannot get liquidated, and there's actually a way through ETH strat that you can essentially get sort of leverage long exposure to things, which I think is very, very nice. And I'll talk to this in a little bit as well as we dive into things. But the nice thing about options is that there's no liquidation risk, which obviously exists for both perps and for sort of
And
like
for
traditional
looping.
borrowers.
Yeah, yeah.
And the other nice thing is that you can get sort of quite substantial leverage exposure as well. The downside, of course, is that you're fairly time bound. So if you buy a 1 week option, then you are, like if the thing doesn't go up in a week, right? If it goes up, in 8 days rather than sort of 7 days, then you don't get any benefit for at all.
Mm,
So
yeah, yeah, yeah. So
you
you
want a
pay the
very, very
premiums.
clear
You pay
view.
the premiums up front, so to speak. Maybe you pay them over time, but you're committing to paying the premiums, and
You're
you
paying
don't
them up. Yeah,
and
correct.
it's based on the time. It's not based on the leverage and stuff. So
Exactly.
for the most part, okay, okay. All right, let's get into this. How to earn 30% per year using ETH strategy bonds. This is the new system that you guys are like currently. I guess is this live or is it in development, or can people do this right now, or is this something that's coming real soon?
We're in audit right now, so it should launch. I don't know when this video
Soon.
will go live. This professor session will go live, Ceazor.
Yeah.
But as of right now, when we're recording, Longbond should release sort of in 2 weeks.
Okay.
So we're talking like early March 2026, basically. Yeah, and we're in audit right now.
Okay. Awesome. So maybe you can kind of walk us through what happens here, and I think everybody can recognize this is like make Sky Ecosystems SUSD, right? Or sorry, just USDS, right? So
USDS, yes.
yeah.
It
So what
doesn't
kind of
have to
happens here?
be USDS.
Mm,
We like Sky. We like what Sky's has been doing. What they used to be known as Maker, but we like the decentralized nature of their stablecoin. We like USDS sort of in particular. Their sort of evolution on DAI. We think that they're doing really, really good things. So we've natively sort of denoted sort of like, for example, our ESPN vault in USDS, but in practice we don't discriminate between stablecoins. So you'll be able to bond with whatever stablecoin you want,
oh,
essentially.
really?
Yeah, USDC, USDT, like the major
Mm,
stablecoins you'll be able to bond
okay.
to
Okay.
us. And yeah, like I won't go into too many details. The reason why it's not a huge difference and it's not a huge problem is that it'll sort of be immediately converted into Ethereum. So, essentially you're going to be bonding to us, and then we're going to be using that bond to buy Ethereum. But sort of like zooming back a little bit, the question is sort of like, what does this whole structure mean? So, essentially, and I think you've given a little bit of an intro on ETH strategy, but sort of zooming in, sort of specifically what's going on here. You're coming and taking dollars and bonding to ETH strategy. So the question is sort of, what does that mean? Yeah. And so I would say it's analogous to you coming and giving corporate debt to someone like MSTR. So bonding, what we call bonding, is like someone coming to provide debt to MSTR. So once you bond, and it's important to sort of like keep this in mind, and so I'm going to stress this point here. When you bond, you become a holder of ETH strategy debt. So you're providing dollars to ETH strategy, that's debt, and ETH strategy will use those dollars to buy Ethereum. That's kind of the whole point of ETH strategy. But you're bonding and sort of getting debt in return, yeah.
Yeah. So you can say
so
that you're lending ETH strategy your stable.
You're lending ETH strategy money, exactly. That's
okay.
Yeah. So bonding is another word for lending, but it's a different type of borrow lend, right? So so in lieu of sort of the standard sort of borrow lend sort of bells and whistles, what you get is you don't get interest in this case, and you don't get liquidation rights. So ETH strategy will only pay your money back after 4 years. So it's a 4-year debt that you're giving. So what you get in return, what you get in is what you get in lieu of interest and sort of liquidation rights is what I think is a lot better. You get conversion rights. So okay, what does that mean exactly? So you've got debt, but you have the right to convert it into one of two things, and you don't have to decide until you do convert. You can convert it into Strat token, which is analogous to in sort of like TradFi. You've got that corporate debt you can convert to MSTR, or you can do something that even Ceazor won't let you do, which is we allow you to convert directly into ETH. And this is something that you can only do on chain, which I think we're really, really excited by, right? Because obviously, if someone wanted to convert, their MSTR convertible debt into Bitcoin, Ceazor would have to sort of find a way to send his Bitcoin to that person. It's very, very complicated, all that sort of stuff, right? Whereas because we're on chain, we're settling on mainnet, you converting your bond into Ethereum is very, very straightforward for us. So
can I ask something? Does that have to happen after 4 years, or 4.2 years?
It doesn't have to happen after 4 years. So you can convert in the value of your conversion rights. Your conversion rights are active for these 4 years. After that, it becomes sort of pure debt. You can get sort of your debt dollars back, but in these 4 years, you have active conversion rights. And so anytime in these 4 years, you're able to convert to either Strat or to Ethereum.
Okay, I'm kind of picturing this kind of like as a like going to Strat kind of seems just like you're buying a token, but so we'll put that on the side. But if you convert to ETH, it kind of sounds like a call option a little bit. Now it's not exactly what I picture a call option, but it's like during this 4.2 years, if ETH pumps like crazy, you can just be like, yeah, I want my ETH, and you get it. Would you be getting the same amount of ETH that whole 4 years, or like is this like a buy low? If I were to do it right now, because ETH is down so bad, and maybe it's going to go down more, but let's say I did it now, and then in 1.5 years, it's like crazy up. I could just be like, I want the same amount of ETH back. Is that right?
Yeah. So the option strike price is set when you bond. So if you bond today, then you would get a strike price that is fairly close to today's price, right? So it will tend to be anywhere from 15 to 20% out of the money. And today that would be like 2,500 ETH, right? So you have the right to get 2,500 ETH essentially. So you would have the right to get 2,500 ETH. And so if ETH then sort of shot up to 5,000, you would still have the right to 2,500 ETH. This strike price does not change after the fact. And you've essentially allowed yourself to get cheap ETH sort of in the future.
Okay, I see. Yeah. So that is functioning like a call option, so to speak.
It is. It is a call option. So conversion rights, another word for conversion rights is call option.
Okay.
You have the right to buy, and you have a call option. And the nice thing about us is, sort of thinking a little bit more about options, and specifically, is that you have the right to convert to one or the other, right? So your call option is unlike any other call option that exists, right? It's actually a little bit different. It's a little bit more exotic, but all in benefit of the user. You have the option, the additional option to choose which asset you want to convert to. And the reason why we give this option is that I think initially it's a lot easier for people to have call options in ETH because ETH is such a widely traded asset and everyone understands roughly how to value call options in ETH. But what you'll find is that, especially if ETH pumps, because Strat is levered Ethereum, the returns on Strat should be higher than the returns on ETH, which means that we foresee in the long run, perhaps not the first few options, but in the long run, there should be a lot of reason for people to convert to Strat rather than ETH. And that's why we want to make sure that that option is there. So even if you come in expecting to sort of, to use the ETH option, right? And you want to sort of farm the ETH option, and maybe you want to sort of gamma scalp the ETH option and earn yield off the ETH option. When it comes time to actually exercise, right? And let's say, you've gamma scalped it and you need to close out your positions. Now your options in the money. You could find that you actually make more money by converting to Strat rather than to ETH. And, that's an additional option that I think no other option has.
Yeah. Okay. All right.
So,
Yeah, I'm good on that. That makes a lot of sense to me. I have a clear picture of this in my mind and no questions. But we can kind of move on to what is this stuff at the bottom, CDT and NFT, I guess.
Yeah. So, so I've described sort of the higher level sort of architecture of things, right? So you bond, and then you get convertible debt. What we've noticed, or what we noticed sort of in TradFi is that, obviously debt and sort of options tend to be sort of used by different people, right? So debt is sort of like more interesting for, especially fairly safe debt is more interesting for sort of like, large sort of, you might say even like pension fund type guys. Options are more interesting for sort of prop desks, right? Like sort of like more tradery type sort of people. And so what happens in TradFi is you get these investment banks, and these investment banks take, let's say, MicroStrategy's notes, and then they essentially script the option from the debt component, and then they sell them separately. So different people can hold the option and the debt component. In DeFi, we don't have investment banks, but what we do have is we have the power of decomposability. And so what we've done is we've essentially pre-stripped our options. So it's not quite perfect. And I don't want you guys to think of like CDT as sort of like pure debt, so to speak. Yeah. In order for sort of you to reclaim your dollars at the end, you do need both the NFT and the CDT amount. But in the short run, the fact that we've got a NFT option, which encodes sort of all the important sort of details about the convertible debt. So you've got the strike price, you've got the notional value, which is sort of like just how big it is. You've got sort of the expiry date. So all that stuff that's important and sort of non-fungible. You get, and then you get CDT amount equivalent to how many dollars you bonded.
And this is like an ERC20, completely fungible token, right?
It's completely fungible across all the different
CDT,
all the different sort of like bonds that we have. So yeah, it's an ERC20, completely fungible. Really nothing special. It's just it's an ERC20. It's the ERC20 that we use within our bonding system. So you can check the code when it goes open source. There's nothing too exciting about it. But I think the thing that I think is really, really cool from an economic perspective, is it means that you, as a debt holder, if you're not intending on exercising your option, you can sell CDT to the market and buy it back in the future. And why that's so cool is because let's say you're able to sell CDT for 50 cents, yeah? And, not promising things yet because they're still in the works, but we're finalizing deals with market makers that will, at least at launch, support sort of CDT price at 50 cents. So, oops, sorry.
No
sorry
worries,
for
no
that.
worries. Yeah, it's okay.
Interruption.
I got kids too. Let's keep going. Yeah. I'm following you still.
Yeah. Sorry. So CDT. So if you're able to sell CDT 50 cents, and we're in the works with market makers to support the price at 50 cents, at least at launch, and so we'll probably sort of have the price sort of floating around there, at least initially. If you're able to sell it for 50 cents, what that essentially means is that you've gotten sort of
half your money back.
ETH strat money, but you've gotten sort of 50 cents out. Essentially, you've gotten sort of like a non-liquidatable loan yourself. So you've maintained your ETH exposure through the NFT, right? The ETH strat exposure, but you've only paid 50% for it. So you've gotten very, very good capital efficiency while doing this.
So just let me clear up something. When you said the market makers are going to support that 50 cents, the thing that I would be afraid of is CDP is worth $2 when I come back and I want to exercise. So are they going to constantly be selling the CDT, keeping it below 50 cents or roughly around 50 cents?
Well, when I said, so market makers are working with ETH strat to sort of keep it there. So it could go up in price, but the reason why I would say, you shouldn't fear too much about things is because CDT can never trade at more than $1. And the reason is quite clear. There's an immediate arbitrage opportunity that opens up when it trades more than $1. So if CDT trades at above $1, what happens is that someone can come and bond, sell their CDT. Remember, you get the same amount of CDT as you get in USDS or whatever stablecoin you put in that you bonded. You can sell that, make the profit, and then you've got a free option. Because the option is valuable, it cannot trade at $1. And so we expect that at least for the first few years, the price of CDT is going to go down. In the long run, there should be an equilibrium because there's an equilibrium in people who want to sort of exercise their options versus people who want to buy their options. And there is some CDT price risk that you take. So it could go up to 60, perhaps 70 cents. But you can think of that almost as like the interest that you're paying off your sort of like non-liquidatable debt.
Yeah, and if you sell the CDT for like USDC or something or whatever it is you sell it for, and then you go put that to work, you probably make that 10 cents or 5 cents or whatever it happens to go up by utilizing the stable coins or whatever it is you sell it to in DeFi elsewhere or in wherever it is you make money, right?
Exactly.
I see. Yeah. Now, every time someone comes, right? Let's say someone comes today and then someone comes in a month, everyone's getting a 4.2 year call option, right? So all of these call options are put like into the future. They're not all expiring at the same time, right? Is this correct?
Yep. Yep. So it's like you think of it that it's rolling in that sense. Everyone's got a different option.
Yeah, I see. Okay. I see this. So yeah, there's a little, like you said, there's a little bit of risk that CDT, if you were to take it away and you were to sell it and you were to like get some stable coins and put them out in DeFi, now you're trying to like, you're going to monitor. And if ETH pumps like crazy, there's a good chance that CDT is going to pump as well because people are going to be coming back to exercise their NFTs. So there's a bit of timing there, right? You got to like, oh, it's pumping. I'm going to exercise it before the flood of exercisers come back. Or you wait until the exercise, until new people come and they exercise or they bond and they sell their CDT and the CD price comes back down and stuff like this. I get it. Okay, yeah, that makes a lot of sense to me.
Yeah.
Yeah, I don't have any questions though. This is clear to me. Oh, the NFTs are obviously they're not soul bound, right? Like they're tradable as well, right?
They're not soul bound. Yes, they're tradable. I think in the long run, we would like there to be a market. We're actually talking to some market makers about setting up a market for these things. But because they're so non-fungible, they're NFTs, but they're genuinely non-fungible from an option standpoint. It would have to be some sort of OTC thing.
Really?
We would love there to be a thriving market for these, but I think it's the sort of thing that that probably comes, with time.
I would think as long as all the metadata shows up, you could find these for sale, or you could put them on sale even on OpenSea or any of the NFT marketplaces. And people who are sophisticated enough and understand the system, they would go and they would check the expiry date. They would check how much money is like put through this NFT and whether it's worth. And you'd be selling it below value as well, right? So if you put 1,000 S, you'd probably be selling it for 800 or something, right? Like every other like NFT, like DeFi NFT out there. Like these are not PFPs, right? These are proper NFTs with like real actual value and
these are financial value NFTs, yes.
Yeah, exactly. Okay. All right. Is there anything you want to add to this, or do we need to move on or something? Yeah.
No, I think this is sort of like the infrastructure that's in place. I think we probably should flick onto the half price ETH article then, because this essentially builds on this idea. This is
I do have a question before we flip off that. Let's go to this how to earn 30. How does this thing like produce 30%? Like where does this 30% come from?
That's the title. So the article on how to produce 30%. So this 30%, how do you make 30+%?
Oh, there's an article on this. We'll get to that article as well, right?
We'll get to the article. Yeah.
Okay, so we can go on to the half price if you want.
Let's go to half price ETH first.
Okay, let's swing over there. So there's this article here. I did cover this today in the podcast. So if I'm putting this out in the next couple of days, it is there. This is live, of course. This article's already out on X. You can check it out if that's something you want to do and read. But let's see what Econ has to say about half price ETH. And if you want me to jump back to this to like help people visualize, then I will jump back and forth. But there is this article for reading. Can you show us how this thing can be used to buy ETH at half price?
Yeah, so I think the thing to consider is because we've built our CDT system, and because at least initially we're going to be supporting the price at 50 cents. Yeah. You can get, if you come and bond, you'll get a out of the money call option on Ethereum. And you're able to get this call option. And remember, unlike sort of other call options that you could buy on some place like Derive, for example, you don't have that liquidation risk. Yeah. So the problem with Derive is that if you buy an option, you have that, liquidation is the wrong word. You have that sort of duration risk. So you buy a 3-month option on Derive. If the price of ETH doesn't go up after 3 months, if it doesn't hit your strike price after 3 months, your option is worthless. Yeah.
Your
if
premium
you buy
is
a 2-week option, it's the same thing, right? If you buy a 6-month option, it's the same thing, right? And they get more and more expensive because you're paying sort of for that
extra time.
For that extra time risk. Yeah. The beautiful thing about ETH strategy is that you don't have that time risk. One, it's a super long option. It's a 4-year option. So, you're protected sort of for those 4 years. The other thing is that even if it expires after 4 years, yeah, you can buy your CDT and get your dollars back. So you buy CDT back from the market, you get your dollars back, and then you can rebond. So not only are you sort of getting long-term ETH exposure in terms of 4 years versus, like a few months if you bought an option at a different platform, you're also downside protected by everything that we're doing as well, right? So you actually have that downside protection as well. So it's this non-liquidatable sort of ETH exposure. And you might be like, well, why don't I just buy ETH for non-liquidatable ETH exposure? The thing about this is that you're getting it for 50% off because you sell that CDT back to the market, you get 50 cents on the dollar. You can do whatever you want with those 50 cents, including bond and get more ETH exposure. Or you can yield farm it and earn yield in the meantime. But essentially what's happened is that, let's say, the price of ETH right now is roughly 2,000. If you bonded $2,000, you would have $2,000 worth of ETH exposure. You had $2,000 worth of ETH exposure, but once you sold that CDT, you get $1,000 back. So you've essentially paid $1,000 for $2,000 worth of ETH exposure. So you've got an ETH at half price. So I will put a caveat in that, okay, yes, you've got an ETH at half price, right? But when things sound too good to be true, there usually is a catch. Where's the catch here? The catch here is that it's an out-of-the-money call option, which means that you give up the first 15, 20, perhaps 25% of your upside. So if you bonded today at 2,000, you'd be giving up your first like $300, $400, $500 worth of sort of ETH movement, which is, at the end of the day, especially at today's prices, I think not that much.
Like you don't give it. Correct me if I'm wrong. You don't actually you're not losing that money. It's just you cannot exercise this until the price moves more than that, right? Like if it's 20%. So yeah. So
you don't have your ETH exposure yet until
yeah. You have your ETH exposure after ETH moves more than 20%. But it's not like you're losing that 20% anywhere.
You're not paying that 20%. No.
Yeah. Okay. Now there is a thing that if you were to get a call option for 2 weeks on ETH, it would cost you, I don't know, $20, $50, $100 or something like that to buy 1 ETH, right, in 2 weeks.
Yeah.
Now that's only 2 weeks. Like, how much do you think, just roughly, how much would it cost for a 4.2-year call option on a regular derived type platform? I know they don't sell them, right? Yeah. But have you guys mapped this out and kind of compared it?
We have mapped this out, and it's actually really, really cool. So obviously there's several different models that you can use. I think the canonical sort of option model is one called Black Skulls. And I think Black Skulls works, honestly, for sort of this sort of back of the envelope sort of calculation. Black Skulls works as well as sort of any of the other newer, fancier models. So, for those who are super keen on options and want to dig deeper, I think, from my understanding, the sort of big sort of diversion away from sort of Black Skulls is really in the form of is really because volatility tends to shift over time, and it's quite hard to price options. So Black Skulls assumes a constant volatility, and so if your volatility is changing over time, you need a different model to account for that. When you're trying to price something that's super long term, we know what the rough sort of volatility of Ethereum has been over the past few years. And it's been fairly consistently around 65 to 70%. And so we can price it quite nicely with Black Skulls. The other thing that Black Skulls fails to take into account is that it doesn't price sort of what they call wingers very well. So wing options. And the reason for that is that it doesn't take into account that those options are essentially more valuable for insurance purposes, and because Black Skulls is a normal based model, I think it underestimates the chances of sort of tail events, right? Black swan events. It underestimates sort of black swan events, which is cool, right? Normal distributions. I think it's a conceptually very, very cool topic. That normal distributions. Financial results do not reflect normal distributions. The tails are fatter. But okay, sorry. Anyways, you can use Black Skulls, and if you plug in sort of all the reasonable outputs, Black Skulls is it's conceptually very cool, very clean. At some point, maybe I'll do another one of these, and I'll walk you guys through the derivation. It's really cool. They won a Nobel Prize for it, right? So Black passed away before he could win a Nobel Prize, but so usually goes Black Skulls Mertens is the model. So Skulls and Mertens won a Nobel Prize for for the Black-Scholes model. So Black unfortunately passed away before he was able to win that Nobel Prize. And then, fun little bit of lore, they launched a hedge fund, long-term capital, which I think raised like $1 trillion, and they went bankrupt. They lost sort of all the money. They bet on Russian bonds. I think they expected sort of bond yields to compress, but instead the bond yields sort of like split apart. The Russian government defaulted, and they ended up losing sort of like basically all the money off that, which shows that even really, really smart people can sort of make really, really big mistakes. Yeah. So if you've lost a bag, in this cycle, I know I've lost quite a bit in this cycle. Just know that you've got good company. But I think the reason why I think Black-Scholes is so cool is you can look at it and you can see the assumptions, and obviously it won a Nobel Prize, and so there's some really, really cool sort of logical leaps through it. But you can sort of like see the points where they sort of like the minds were turning. So the derivation itself is a very, very cool derivation, I think. But all right, so besides the point, I think the derivation I think is super cool. At some point, I'll take everyone through it. The equation itself it looks complex, but it's fairly deterministic, right? You just plug it into the equation. There are plenty of sort of online Black-Scholes calculators that you can use, and so you don't have to take my word for it. But if you plug in sort of these numbers into the Black-Scholes, so it's roughly 70% sort of volatility. You don't have to take my word for that either. You can pull a price feed of Ethereum and just take the vol rate, take the standard deviation of Ethereum price returns over the last few years. You'll get roughly 70%. So you plug that in. You plug in a 4-year tenor. You plug in sort of the out of the moneyness. The interesting thing is that the out of the moneyness doesn't actually affect the price too much. So you plug in 20-25%, won't affect the price too much. And then you plug in sort of today's sort of price. You have to plug in a interest rate. Interest rate won't affect things too much. You can put in 5% or whatever you think DSR should be. So whatever you think is a fair sort of like risk-free sort of rate in crypto, plug it in. And you'll find that, I guess, drum roll. It's been a long diversion to get to this, but what you'll find is that the Black-Scholes valuation of a 4-year option is going to be almost 50% of the price of an Ethereum today. So if you were to go onto a market and ask for a 4-year option, and you can ask for a 4-year option, it's not on Derive or Deribit, but someone will sell it to you OTC. They will charge you 45 to 50% of the price of an ETH today. So ETH is about $2,000. It'd be like $900 to $1,000 yourself. You can do that calculation yourself and sort of satisfy yourself that this is true.
Yeah, so it's very similar to what you guys are doing with the ability to sell the CDD. I was, to be honest, I was predicting just like no math at all, no napkin math. I was thinking something crazy, like something way higher than the current cost of ETH. Like, because like I know options are usually like 1 month, 2 months, 3 months at most, and 4.2 years of me would just sounded to me like it would just be like, you're crazy, man. I'm not going to sell you an option for 4.2 years away. Like, no way, right? Like it's just too scary. But I guess math can work forever, right? Like the Black-Scholes.
Math can work for you. Like the thing to remember here is that first, as a retail user, you can't really buy these options OTC. If you buy in scale, you could. The other thing is that unlike that situation, like our options are much, much better because they're not pure options. They're still converts, So you have that downside protection after 4.2 years. So
you get your money back if it doesn't work.
Exactly.
Yeah. Okay.
So what I would recommend, Ceazor, if you find some users who are like, I want to OTC some 4-year options, for let's say 50%. What you should do is you bond to ETH strategy, and then sell them that option. You can sell your CDT, and then you can sell them that option, and then you've gotten free basically value.
Yeah, let's say I wanted to do that.
Sold that option to them.
Yeah, let's say I wanted to do that. Wouldn't it be noble of me or moral correct of me to sell them both my CDT and my NFT? Like if they're like, hey, I want a 4-year option on ETH, and I'm like, okay, sure. And then I come to Strat and I buy it, I get this option, and then they pay me because I'm selling them an OTC option. Wouldn't I have to give them both the CDT and the NFT that
Yeah.
I? Because they would have to have the power. I wouldn't
No,
ask.
you would.
Does that make sense? Like
No,
they
you
would
could
have
sell
to
them an
be able.
option through you.
Oh yeah. Oh, I see.
So
Yeah.
I think
That makes sense.
another thing that I think is important to sort of another thing that's important to realize here, and I think this is one of those things where the more you unpack it, I think the cooler it becomes. Yeah. I
Yeah,
think
like
the
as if they
really
don't
interesting
even know
here,
that need to know that I went to ETH strategy. That's what you're saying, right? Like
you
they
don't
could
they don't
just
even
be.
know that it's ETH strategy, right?
Yeah. I
But the
get it.
other thing to realize is that your option, Caesar, yeah, when you bond to ETH strategy, is not denoted in dollars, it's denoted in CDT.
Hmm.
So it's 25% out of the money. But if you pay for it in dollars, yeah, what's happening though, of course, is that you're not going to come back and buy it with dollars. You're going to come back and buy it with CDT. And it's
Hmm.
possible that CDT rises in price, right? So you sold it for 50 cents and maybe it gets to 70 cents, yeah? But even at those rates, what's happening is that if you on sell your option at 25% sort of out of the money, you sold your CDT for 50 cents, right? If someone wants to come and exercise it, if that, let's say your mate wants to exercise it, yeah, he will give you a dollar. He will give you in dollars to exercise it. You can go out, you can buy your CDT back, let's say for 50, 60, even 70 cents, and you pocket the difference.
Yeah.
So
I
in
get it.
essence, like we're saying, you're getting a 25% sort of out of the money sort of option, right? But it's denoted in CDT. So you might say it's almost like in the money according to CDT prices.
Yeah. I get it. Yeah, unless
But
it's
it
like
is it
unless
is
90 cents.
significantly better. It
Mm.
is absolutely superior actually to hold a ETH strategy, even a raw NFT without the CDT. It's better to hold that than a standard Fourier option.
Yeah. I totally get this. I completely understand this article now. This 50% ETH.
Yeah,
I'm gonna refresh. I'm gonna reiterate it, and you correct me if I've understood anything incorrectly. So it's if I go to the market and I buy ETH right now, I'm gonna pay it's 1,966. So let's say $2,000 for one ETH. But if I come here with $2,000, I get an NFT and I get CDT. I get 2,000 CDT.
yeah,
I can sell those CDT for 50 cents each,
50% each. Yeah,
roughly, right? Roughly
roughly.
about that.
Yeah,
So I actually pay $1,000 to get one ETH, but it's only exercisable in a little bit of time when ETH goes up 20%. However, if it never goes up 20%, I'm going to get back my $2,000 as long as I
yeah.
can get my CDT back.
I would say it's not exactly one ETH. It'll be a little bit less than one ETH. It'll be like 0.8 ETH, right? So it's like you've lost that 20% of ETH exposure
Mm,
because of that. But that's you've gotten it for much cheaper
yeah.
as well. You've gotten
Okay.
it for half price.
Yeah.
And you've gotten downside protection as well, right? So I'd say that usually when we think about these things, right, the conversion debt, the fact that you've got downside protection sort of makes up for the fact that you lose a little bit of that upside exposure, which is the out of the moneyness. But here, you've actually gotten this for cheap. That's why we say it's half price ETH, right? You've got an ETH for half price essentially.
Yeah. Okay. All righty. Yeah, I got a clearer picture of this. We do have another couple pictures to look at and articles. Where would you like me to hop to, or do you want to add anything to this?
No, I think I guess just to round it off, I think this is a really, really cool way. Because everyone wants more exposure to ETH. What you can do in these situations is if you want max exposure to ETH, what you can do is essentially you can bond, you can sell your CDT, you can rebond, and you can sell your CDT again, and then sort of loop that. If the price is at 50 cents, essentially you get two exposure to ETH. And remember, this is non-liquidatable exposure to ETH, yeah?
Yes, exactly.
So I think that's really cool. So you can get essentially leveraged non-liquidatable exposure to ETH. And it's non-liquidatable because, remember, you're actually the lender in this situation. You're not the borrower. So we've built this system where you're still lending money to ETH strategy, right? Like you're still on the hook. You still got to buy back CDT from the system. So you've still lent money to the overall system, but you've gotten sort of 2x exposure yourself.
Yeah,
So
yeah.
there's some very, very cool financial engineering that I think we've sort of designed here. And yeah, we really want people to use it.
I'm not a mathematician. I'm pretty bad at math, but like the way I kind of visualize it in my head, you say 2x exposure, but it's more like something like 1.8889999 or something like this, right? Because like every time you're getting half the assuming CDT is sitting at 50 cents, right?
Yeah.
You're getting half the money back, and then you're bonding, and you're getting half and half and half. But
Well,
I guess if
at
you
the
look
limit, it becomes 2, yeah?
Yeah,
So
yeah,
it's sort of like,
yeah.
So the first bond you get 1, let's say. Then the second bond you get 50% exposure, right? And then the third bond you get, so it would go
30,
down and
yeah,
you get
yeah,
25, right? And then if you kept on bonding, the limit is 2. But okay,
yeah,
in
yeah,
practice you would stop somewhere at like 1.9, let's
yeah,
say.
yeah. I see. Okay, okay,
Because you don't want to bond anymore. Yeah,
awesome.
but yes.
Okay, yeah, yeah. I've got it. Yeah, this is awesome. This is really clever and cool, and I think it's accessible as well. Like what we've talked about is not. You don't need to be Black Scholes to understand this and to do this. Like, I think it's pretty accessible. Like now that you've explained it to me.
Yeah, we hope so. We hope so.
Yeah.
We think we're building cool DeFi Lego. That's the way that we look at it.
Yeah, totally.
And we
Yeah, and
want,
someone can totally build on top of this, like especially if they're like, you know what, I just want an option. I don't want to like understand this. They could just be okay. Don't worry about it. We got you covered, and they could do it for people. And like you said, like I could do my buddy. You know, my buddy wants an option. I could be like, yeah, I'll give you an option, and then I could go here and do it myself, right? So there's that composability as well. There could be products built on top of this that kind of handle the complexity here and understand this complexity and maybe extract like hide it, or I don't know. Who knows what people come up with, right?
yeah, 100%.
Okay. You want to move on to this guy here? What's this?
Yeah. So I think we can.
I think this is
We can. I
explains
think
what
this
you
is
told
very
us.
similar to the previous one. Yeah. So this just shows the looping. So you
Mm,
can bond, and then you can get the CDT back. I think let's go on to the let's go on to the 30%, the actual 30% yield. So how can you make 30% yields with ETH strategy bonds? Yeah,
mm.
30% plus yields with ETH strategy bonds. So I think there's actually several ways you could do it, but I think the way that we outline in this particular article is that you can bond to ETH strategy, and then you can sell short dated calls on a platform like Derive. We've used Derive in the past, and we can highly recommend them. But a platform like Derive to generate sort of long-term yield. That's Derive's nice little UI there. So essentially, because you have a call option, when you sell a short call option, you are 100% hedged. And so the premium is just pure profit for you. So you're just farming pure profit.
I see. So it's like a basis trade in a way, sort of.
Exactly.
Right?
It's a basis trade, but instead of trading sort of people's tendency to go long, which is essentially what the basis trade is, you're trading sort of volatility. And so the nice thing about this is that volatility will always have a risk premium attached to it. So you might say that the standard basis trade on, let's say, on perpetuals, it's kind of irrational. It kind of only exists because crypto people are super bullish. I'm super bullish crypto. I love going long. I don't like going short myself.
And degenerate as well.
Yeah, I'm degenerate. Yeah, I'm very degenerate. Yeah, like
no, I mean crypto people are degenerate, and that's why perps are so. There's a basis trade. There's a short.
I'm super degenerate as well, right? Like when I trade with my personal money, I go long perps, and I go 10x. degenerate enough for you? Sometimes I go 50x, but that's a bit painful when you get liquidated.
Yeah, it's too fast.
It's
There's
too
no
fast,
pleasure
yeah.
in that. Yeah,
You don't even get to enjoy yourself.
there's no romance at all with that.
There's no romance with. I think 50x is too fast, but 10x, man, 10x is a day's worth of fun. So,
yeah, totally. Yeah.
So 10x can be a lot of fun. But yeah, so I think yeah, so I'm degenerate as heck, but the nice thing is that like when you talk about volatility and you talk about volatility premiums, they don't really change very much because they're driven by fundamental demand. There's always going to be demand for hedging. There's always going to demand for sort of like protection against sort of downside volatility movement. And because of that fact, these premiums sort of remain sort of fairly constant. So there's this concept in sort of options which is called implied volatility. In implied volatility, it basically tells you sort of like how much the price of the option that you're selling for, like what's the volatility you need to plug into black skulls to get this price basically. So it's kind of like if you guys think back to sort of your maths classes, like an inverse function, yeah, instead of y equals x, you get x equals y, so you flip it around, right? F, f of x dash -1, right? This is how they usually denote it. So implied volatility is basically that. And what you'll find is that implied volatilities in Derive are relatively constant. So I think that's pretty good.
Does Derive have a term or a metric, something like open interest, is there like $100 million constantly on this platform looking to buy options, or is it like $100,000, or you know what I mean? Like, is there some sort of metric on there that kind of, so people can kind of visualize like that's a farm that is always there, ripe for picking and ripe for harvesting? That's kind of what I'm getting at, if that makes sense.
Yeah. So at, you might say, retail scale. So if you're doing like, let's say you bond like anywhere from, let's say, like anywhere less than, let's say, $500,000 to $1 million, the liquidity is there and it's efficient, and they have a book. I think Derive has a constant book that buys sort of options. So you and I can quite comfortably do it. For larger sort of like amounts, like we do with ESPN, for example, Derive will have to call market makers. But option demand is basically sort of constant, in the sense that, like, we've talked to the Derive guys, they're pretty confident that they can get us $100 million of demand very, very easily. And so, if someone out there, if you, Ceazor, for example, wants to bond like $10-15 million, there should be no difficulty in doing that. Just tell me so I can get a middleman fee from Derive.
Yeah. Don't worry, man. I don't have $10 million to bond, but I wish,
Not
man.
yet.
Not after last year, that's for sure.
Oh man, this has been shocking, hasn't it? Like,
yeah.
I hate but that's the thing, right? The nice thing about options as well is that, especially if you run these types of strategies, especially if you use something like ETH strategy, yield might go down a bit, but you're insulated. Your capital, at least, is mostly insulated from the market sort of going up and down.
Okay, so with this 30% yield strategy, right, you're kind of stepping away from this strategy, right? Because you're kind of giving up the upside because you're selling downside. So it's more for a person who's not long ETH, who doesn't want long ETH exposure and just wants to farm both sides of this volatility, right?
Exactly.
Okay.
Yes.
Okay.
So I would say this is for a different profile of user. So if what you want is half price ETH, then you don't need to touch Derive. You can just, you just go there. You can bond, sell the CDT, and then do whatever you want with CDT. But because you want half price ETH, probably you want to bond again and get more ETH exposure. This is a different way to monetize your option, where instead of getting that long-term exposure, right, to ETH, what you want here is you want 30% per year using ETH strategy bonds. Yeah. So what you want to do is you want to take those options and you want to use it to cover short options on Derive.
And there's no interaction between your tokens and Derive, right? It's just like there's a social or like a personal interaction, but it's not like I'm actually taking my CDT to
No,
Derive and selling it, right? I'm just opening positions there and opening positions here, and they're balanced out and hedged, right?
exactly.
Okay.
So that's yeah. So I think that's just yeah. So this is just um
It's
this
like a
is
hedge. It's a basis
it's
trade
a hedge.
hedge
Yeah,
type
it's a
thing. Yeah,
hedge.
yeah, yeah. Yeah, yeah. Okay.
It's a basis trade hedge, right? So yeah, so I would say yeah. Eventually, we want to incorporate everything on Derive so that it becomes more and more seamless. But for now, there are some risks, right? So we should be cognizant of risks. Especially if you're using Derive, you have to provide your own collateral Derive. When you're short options, they do have liquidation, so do look out for them as well. Um, because like our bonds are not on their platform yet. We're working on finding a way to integrate them there, and if people sort of make enough noise, especially on Twitter, I'm sure Derive will do that. But for now, you should be cognizant of that. Like your financial risk is zero, but operationally there's still risk, unfortunately. Um, and yeah, and I think if you go through the article, it talks about sort of exactly how to do it. So I'd say I think the yields can be sort of very, very good, especially if you sell some CDT and you can sort of get more returns. Yeah. It depends on sort of like how much CDT you sell and how many options you get. So I'd say the base yield is sort of roughly sort of 20 to 23, 24%. You can sort of check out sort of how the article looks. But obviously, if you amplify that by selling your CDT back to the market, you could get like 40 plus sort of returns. And depending on the market, we want to be sort of like fairly sort of fairly careful with stuff with our claims, right? So we say it's 30 plus returns if you
Mm.
amplify it with selling CDT back to the market.
You
So
could
I
use your
think that's sort of
CDT to open the position on Derive, right? Like you could sell the
you
CDT
could
and
use
then
your
use
CDT
that.
to sort of open a position and Derive as well. Yeah. So if
Mm.
you sell CDT back to the market, you have to find another way to collateralize things, but you could use your CDT to open it in the market.
Okay,
Um,
okay.
anyways, all I'd say is that if you're interested and keen, you should go through the article. I think we go through in quite a lot of detail, like how it works, what the risks are. I think it's a really good strategy. It is very, very similar to the strategy that we're using on ESPN ourselves. Um, and it's just a good yield earner. And I think unlike other things that sort of return sort of 20% plus, uh, I would say most things that exist in the market that return sort of 20% plus, uh, they are they're pretty they rely on like leverage looping, yeah. They
Mm.
rely on leverage looping, they rely on uh
Reward tokens or
reward
yeah, yeah.
tokens. They all rely on these short-term things, and that's great. If you're into that, that's great, yeah. But the thing about those is, and I think everyone who's into this sort of stuff understands it. They're not long-term. You can't make you can't make consistently 20% yield sort of in the long run. And you can see sort of with ESPN, sort of even in this very, very rocky, very, very down movement, we made like about 19%, right? It's 18.5 sort of percent over the past 5 months. And this is all real. We don't have any rewards tokens here yet. We're not counting in any rewards tokens. Um, yeah, this is all just pure real sort of return.
So,
Real genuine return, yeah.
like when you were talking about this basis trade, it
Yep.
came to mind the Athena doing the basis trade with the perps, right? This
Yes.
is a stablecoin could totally do this as well, right? Like someone could launch a stablecoin and use that stablecoin somehow to
Yeah,
run this strategy,
100%.
right? And like you
100%.
said, like it's sort of what you guys are doing at ESPN, but
Yeah.
you said the word sorta. So can you articulate what is actually different happening under the hood of this ESPN than what is happening in this basis scalping thing?
I think the so because it's ESPN, we get slightly more favorable options. So with ESPN, we will automatically convert. So ESPN can only use the ETH bonds to uh they can only use it to scalp basically, right? There's no other mandate. So ETH strategy, when it bonds to, so when ESPN bonds the ETH strategy, it can only use that to sort of like cover short dated calls. I can't really hold that as a long-term ETH exposure. And because of that, because we know that, because we're controlling ESPN, we're able to give slightly better or significantly better options to ESPN. So we give 5% out of the money, 5 to 10% out of the money options to ESPN. So, and that's because we know that we will convert them and that will accrue EPS faster. So there is that factor. And another thing that we are doing at ESPN, if you look sort of at the information, is we're also selling some cash covered puts. And so cash covered puts, the way that we think about it is that we've taken cash, we've sold a put on that cash. Essentially what we're doing is we're pre-bonding. We're bonding sort of at this price. So you can see that we bonded at 2,800. At the time where we bonded it at 2,800, where we sold those cash covered puts at 2,800, the price was close to 3,000. So we got a discount on bonding. We could have bonded, but we didn't. But we got a discount on bonding at that time. And on top of that, we earned some yield as well because you obviously get paid for those cash covered puts as well. So obviously you can incorporate that into your strategy as well. And when I personally sort of run this trade, I will be incorporating that into this strategy too, because I think it makes a lot of sense to do that. Yeah, when I personally run this, I'll be incorporating some cash covered puts as well. But I think that's something that I think that's something that we're still working on, sort of like making available to sort of the general public on the ETH strategy side.
One of the things you said about this that I want to clarify, when this ESPN bonds, so they're doing the same thing as this, so to speak, right? Slightly,
Yes.
right?
Yes.
When they bond the stable coins into here, they get the they do not basically they're not getting this NFT. They cannot exercise and get the ETH. Is that correct? Is that what I heard?
They can exercise and get the ETH, but they can't, like, so the thing is that for ETH strategy, if you think of sort of like the biggest boon for ETH strategy is people exercising. Because when people exercise, we lock in accretive dilution. It's very good for us. So we want ESPN to exercise it, and we want them to exercise it often and quickly, because we control ESPN, and we know that ESPN is selling short-dated calls. We know that in likelihood, it'll exercise its options very quickly.
I see.
Whereas if we give it
it's
to
the
you,
opposite
right?
of what I said, right?
Yes. So if we give it to you, we don't know whether you're going to exercise it quickly or not.
Yeah. Okay. That makes sense to me. So you guys can give out of the money that's closer to the current price because if it does cross that price, it's going to be exercised.
Exactly.
Instead of waiting until it's worth $10,000 and then it doesn't the money's not flowing through the system.
Exactly.
Okay. Yeah.
I think it's likely that we'll probably launch a yield product where you could just take your options and then ESPNify it, right? So there's probably something like that where we split ESPN into some more building blocks that people can play with, so that you can earn yield yourself and perhaps a little more flexibility of how you use ESPN. But right now, there's that sort of preferred sort of nation status. And we're thinking of ways to sort of like let everyone sort of use that as well.
We're into like about, what time is it? It's over an hour now.
Yes.
Do you think we can do a little bit of gamma scalping talk, or is this going to take another like hour of this is not easy stuff, right?
I think gamma scalping is not easy. I can give a quick overview, and we can do another call to sort of go deeper into this.
Let's do that way.
Cool. So I think one of the things you touched on earlier is, why is there so much demand for options? And am I worried? Are we worried that sort of option demand will dry up? And the answer is no. And one of the reasons why the answer is no is because you could actually extract the value of an option without needing a fundamental user. So it's like
you mean a counterparty?
Yeah, you don't need someone who
wants to buy it.
hedge,
Yeah.
You don't need someone who, like, so if you think about options, there's a lot of reasons to want options. Yeah, you can use it to hedge sort of price movements. You can use it to sort of leverage up. You can use it for like a lot of like it's very flexible, very useful sort of financial instrument. But I think the coolest thing about options is that it's like one of those like RPG like weapons, let's say, where it's really cool. You can use it for like you can use it as a weapon, but if you don't need it, you can actually break it down into its constituent parts. And in obviously, in medieval sort of RPG world, you take your sword, you break it down into iron and wood and all that sort of stuff, right? In financial DeFi land, when we say we break it down into constituent parts, we get the value, the dollar value out of it. We get dollar value out of it. And so that's the reason why, options tend to be fairly, what's the word? I'd say the options tend to be fairly
utilized.
Fairly well priced. There's always a good market for options, and the reason for that is that you can profit off them. And so gamma scalping is the way that you can do that. So super high level overview. I think it'll probably take a lot of time to go into everything in detail. Options are curved. So if you think of the option value chart, it's curved. I don't know whether we've written it there, but
I'm looking to see if there's no. There's no image of a curve.
Oh, there's no image of a curve. That's a bit unfortunate. We should add that there at some point. But if you think of options, right? Options aren't like sort of spot assets. I think the most interesting thing mathematically about options is that they're curved. And so what that means is that the delta, the sort of like the change in option value, depending on top of sort of the underlying value, right? So you have an option on ETH. If ETH goes up $1, how does your option change in value? And the answer is that it changes at a changing rate. The fact that it changes at a changing rate, and not just that it changes at a changing rate, it changes at an increasing rate. So the fact that it changes at a different rate means that the option is convex. And because it's convex, what that means is that if you delta hedge at a particular point, wherever the price moves, you end up making value out of it. And so this is gamma scalping. So gamma refers to the convexity of the option. And so you can essentially make delta neutral money, value, out of the convexity of the option.
Yeah, I kind of understand a little bit. Of course, I need to do my homework to really dig into there. But I get what you're saying in that, like, when the price moves, it has like kind of like exponential effects on the price of the option. Because
it does, yes.
Yeah, because now like it's more likely to be exercisable. It's more likely to go into the money, or it actually has gone into the money. So it becomes a lot more, it has a much bigger effect on the value of that option. It's not just the prices moving up or down. It is now also affecting the ability for it to be exercised or not, right? Is that a correct statement?
No, exactly. Okay. So it's just like this concept of time value of money.
Yeah, this is a pretty deep article here. Like I tried to read through this thing, and it's just like, it's like punches in the head. You know what I mean? It's pretty rough for somebody like me who, like, I'm not an economics educated person. I didn't study economics in school. So yeah, it's definitely something that, I want to learn, because it's just like, it's just cool and amazing and just beyond my understanding. And that's what I like to learn. But yeah, like maybe really getting into this, like I don't want to like drag you through a whole nother hour of like gamma scalping explanation, but I think I have a pretty good understanding. I have a very clear understanding of this now, and how the bondings work. If you're a user and you're looking and you're like, yeah, even this is too hard for me, I would suggest you to kind of look at this ESPN, because it's basically giving you guys the ability to do that, right?
Yeah. Yeah,
Eh,
exactly.
Or you
And
can
we'll run it for you.
bond
Yes.
for strat, right? And then just stake the strat. And if you do stake strat, currently right now you're getting ETH about 9%,
It's
right?
good. It's good
That's
yield as well. So
because this is yield in ETH, right?
yeah.
And that's only because like everyone who holds strat has staked it, right? For the most part, right?
Not
Not
everyone
everyone.
is staked it. Yeah, there's still some good yield.
Yeah, yeah. Anyhow, yeah. Is there anything you want to like add or mention, or do you want to
No,
call
no.
this call this a day? And
I think this is yeah. It's been a great call. Happy to
yeah,
take. Very very excited to take you through everything. And we should do another gamma scalping one at some point.
yeah, I do. Yeah. It's
We can
been
go in detail about options because there's some really really cool things.
there's a lot here, man. This is like I'm already like amazed at like how cool this is already. Like how easy this is to. It just makes perfect sense to me. Like 100%. And like if I can explain it, then it logically makes sense, right?
Yeah, no, 100%. And I think this is so cool, and I feel like we're building something really really awesome. And if there's one frustration in my life, I think it's that I'm not that good at making other people think that it's awesome too.
Yeah. We both kind of have salesman problems. Like we can't sell things, right? But to be honest, like this thing, there's nothing out there like this. There's nothing in DeFi like this. If you ask anybody, you could probably ask me, and I've never seen anything like this before. Now there might be something similar, like I can kind of draw parallels, like Pendle, for example. You get, principal token and some interest token, like a yield token. So there's some parallels a little bit, but there's nothing like this out there, and I love to just share and to learn about these new things, these new primitives and DeFi Legos that are around, and I appreciate it, man. I appreciate the time, and yeah, let's book another gamma scalping one where we can kind of actually really go in deep on this and kind of see it and think about it a little bit deeper, because this is another option somebody can do if they bond, right?
Exactly. And
Mm.
I would say once our product actually goes live, which will be in 2 weeks from when we're talking, I'm gonna personally go and stream gamma scalping because I think it's so cool. So every day I'm gonna come on and I'm gonna stream. It's nothing too crazy, right? Like it's a fairly nice sort of relaxing thing, but we farm a little bit, we'll make a little bit of money out of it. Um, and I think yeah, I think gamma scalping is really cool. And um, I think there are, at least I have some hypotheses on it. Like we should talk about sort of what the base level is. But I have some hypotheses that because not that many people have experienced scalping sort of 4-year options. So I think there are sort of, even from a TradFi perspective, there is a feeling that we're kind of sort of on the edge of what is known here. And I've got some hypotheses that might allow us to sort of make more money. But, like, obviously this is like DYOR, and it's even research is sort of like not quite sure. Like I've done some digging onto like sort of academic articles, and there's going to be a lot of research sort of on this edge. So there might be some cool novel things that I will share with everyone.
Awesome. Yeah, I appreciate it, man. Yeah, let's do this call again soon, man. Like, especially like after, like, it would be totally cool if I could kind of, like, if you're gonna go on live, whether it's through me and I see it or whatever, like, I'm definitely gonna watch you do some of this, like, gamma scalping, because it's just cool shit, right? It's
Yeah,
like, yeah.
it's like it's one of the things that's quite complicated. But I think it's also, at the end of the day, like it is free money, right? So it's not going to be that easy. So
Yeah,
like
and that's what you
it is
kind of need.
Delta neutral. Yeah?
And that's what you
Yeah,
need in like you need that edge, right? Like people like in
exactly.
like the whole like yield farming thing. We still have an edge. Like we're like everyone who understands even like liquidity pool, like adding
Yeah,
or looping on Aave or Morphle or whatever. Even that, like only like 1% of the population of the world knows what we're talking about, if that, right? So we're already still ahead, and this is like 1% of those people know what this is. So it's just like you're super in the weeds. Now maybe there's some TradFi people that understand gamma scalping and would understand you, but don't understand what
But they don't
liquidity
understand
pool
DeFi, right?
provisions.
That's
Yeah,
the
they don't
problem. Yeah.
understand DeFi. Yeah, yeah. So there is some
Yeah, they don't
overlap there.
understand like a lot of these, and I think this is one of the things that we want to get DeFi people using this because this is really genuinely awesome. Yeah, I think that's basically it.
All right, dude. Let me close this up now, and we'll stick around and talk a little bit more. But I think that's enough for the video that I'll put out live and for everyone to share. And I hope to God everything went clear. This is the first time we've recorded one of these, so we'll see how it goes. So let me press the end now, okay? So you can say bye and see you later.
Yeah, thanks for having me.